AllianceBernstein. Voy a saludar ya a Teresa. Teresa, thank you so much for being in Negocios Televisión. Good afternoon.
Good afternoon. Thank you for having me today.
Teresa, global equities pulled back from the highs that we saw in the first half of the year, and we seem to have entered now a choppier time in the markets. From an equity perspective, can you comment broadly on the current environment?
Yes, good afternoon, everyone. Yes, global equities did certainly pull back in the third quarter and away from the highs that we saw in the first half. If we look at the broad market in terms of the MSCI World, it declined by about 3.5%, reducing those year-to-date gains. And equity markets primarily sold off as bond yields rose, mainly pricing in that higher for longer scenario for the economy. And I guess investors turn back their attention away from all the excitement of AI back to the macroeconomic uncertainties that we're all seeing in the market today. And technology as a whole declined. Energy was the best performing sector, and mainly because of those tighter supply conditions driving that oil price higher. And then, of course, the US again was very strong, defying expectations, accelerating when many had expected, in fact, slower growth. And the real explanation behind that was really the consumer. And the consumer continued to dig deep into their wallets and continue on spending, mainly because the labour market was also strong. But as I mentioned in my last session, there are still significant concentration in the market, and particularly with regards to the US equity market, the Magnificent Seven and the top 10, accounting for that large proportion of returns. And as an active manager, it has been challenging. And we would say that valuation risk actually has greater risk than earnings risk, for example, mainly for investors that are heavily exposed to the mega caps. And of course, high valuation, of course, can potentially cause issues in terms of drawdown. And we saw that in the 2022 bear market. And then finally, rising commodity prices, they're posing a challenge and certainly an upward tick in the risk bucket in this environment. So all in all, certainly choppier and more fragile than what we have seen and what we're used to.
Teresa, given the current backdrop, how are you all managing all of these risks?
Well, we're very much an active manager, high conviction, core active manager, but clearly we're keeping an eye on the macroeconomic environment. We have to take into consideration all of these risks and macro risks holistically, and I would include climate risk in that. We can't deal with those risks in a linear fashion. And actually, if you think back to 2022, and in fact the last 3 years, they're really a very good illustration with regards to the way we think about risk and return. And so in 2022, you saw that the equity market and the bond market were very much positively correlated, whereas our active approach to those factors of quality, stability and price provided very much an uncorrelated source of return, mitigating that risk, but not only that, providing that upside capture from October 2022 all the way through to today, really, in fact. And then if we look at the last 10 years versus the next 10 years, well, certainly if we look back, the frequency of drawdowns certainly have been less by historical periods. The future is going to be different, and we're certainly aware of that, and we're managing to that sort of choppier environment. But if we look at the annual 12-month rolling returns and in falling markets, our active approach to quality, stability and price actually delivered a positive return in those falling markets, a positive return of 1.6% when the markets declined by roughly over 7%. And then in terms of a modestly rising market, we delivered 10.5%. That's over and above the broad market, which delivered 5%. But then in a very strong rising equity market, our approach we will lag, because our objective is to deliver that 90% upside with less risk overall. So I think by understanding and mitigating the effects of volatility on portfolios, really what we're aiming to do, we're enabling investors to stay invested in the market and also to really realize their medium and long-term goals.
Teresa, managing the upside and the downside risks is a tricky task, so I wanted to ask you, what are the key features of your strategy that enables you to manage these risks?
Well, yes, I agree. Certainly when you're managing, and when you think about managing to the upside as well as managing the downside, because we're seeking to achieve that long-term capital growth overall for our clients, as well as mitigating that risk. It really comes down to the characteristics of the companies that we're investing in. And we believe that active defensive strategy should be grounded in those company fundamentals. We're looking at quality, and by quality we mean, high return on assets, measures of profitability like return on invested capital, but also stability. We're looking at companies with recurring stable revenue, low volatility of returns in all relative to the market. And then in terms of price, mitigating that price will always be important, making sure that we're investing in companies that are less susceptible to wide market swings. And we've seen a few of those swings in the more recent period. And that'll give you some of the sense of the characteristics that we're looking for. And our company analysts, when they're out on the road, they're asking exactly these questions. They're asking questions like, are the earnings sustainable? Are the cash flows stable? What's the product or service that the company is offering? What is its position relative to its competitors? But also in terms of unpredictability, is there something coming down the pipeline that we need to be aware of? So it's those key questions that we're asking of companies. And in terms of the current environment, that's exactly how we're positioned. So we're countering that interest rate risk and inflation risk with quality, as well as identifying those future drivers of economic growth. And then in terms of stability, we're offsetting that earnings risk, which is really important today, and then that price risk, as I mentioned as well.
For the rest of the year and for 2024?
Well, in terms of the rest of the year and for 2024, we're certainly positioned to deliver that equity return, but mitigating any risk that we're finding in the marketplace. Where we continue to believe in company fundamentals and try and identify those quality, stable companies at attractive price in order to deliver on that long-term capital growth. And we're finding these companies not just in traditional defensives, we're finding these companies across industries, across sectors, even across sectors like technology and industrials. And within industrials, we like names that are enabling that transition as well. We're dynamic on offense and defense, meaning that risk is always present in the market, and that's our job as active managers, to identify those companies. We take into consideration, earnings sentiment, behavioral biases that companies may have and individuals may have. And then finally, in terms of not predicting the market, we're steering clear of unpredictable forces, and we're just investing in quality, stable companies at the right price. And when we look at how we're delivering on that in terms of risk reward, currently we're in the first percentile and in the top quartile, actually over 1, 3, and 5, 10 years and since inception. So we're delivering on that upside and downside, as well as that uncorrelated pattern of returns, all in all for our clients.
Teresa Keane from AllianceBernstein, thank you so much for being in Office Television this afternoon with us. Thank you, Teresa. Good afternoon.
Thank you very much. Bye-bye.
Bueno, pues de los mercados financieros pasamos ahora